Welcome. I'm Ira Epstein. I'm here to talk to you about the impact of today's U.S. jobs report, the upcoming CPI and PPI. Many of you know me from my commentaries all over the internet. And of course, you see me on different areas where I get interviewed. In any case, this morning we had the November jobs report. And if you take a look at it, we're going to get next week the CPI report, which backs it up or negates the impact of this, and the CPI report. So we want to keep our eyes on all this. On the monthly November non-farm payroll, the recap came out this way. You're looking at 227,000 jobs. The estimates were really close to the 215, 218 level. The unemployment rate picked up a pad, 4.2%. Some people thought it would come in at 4.1. They did a small revision in the October number. They went up for 36,000, but that kept the unemployment rate unchanged. When we break the market down and we look at the private sector, the government, and so on, good rates here, good participation, slipped a little bit, but I'm not too nervous about that. You're still seeing no wage inflation. We haven't gotten to the point where wages are dropping and inflation's going up. So to a degree, you could say it's keeping track with it. What the market's going to do with this number is they won't just look at the 227. What you've got to do is step back. Some people properly will use, I think, a 3-month moving average. Others will go to a 4. Is there a right answer? No, it's whatever you're comfortable with. But the reason you want to go back in time and get at least 3 is you want to take out blips in the market. What's a blip? Hurricane? A strike? Because what happens is when you can't work during that, eventually you go back to work. The strike, people settle strikes normally. They're back at the job. So you want to take this down, and if you do that, I don't know if you're going to go a 3 or a 4 month, you're probably going to end up near 170,000 new jobs. For an economy as strong as ours, that's still a fairly tight labor market in the demands on it. Now, as we take a look coming Wednesday at the upcoming CPI numbers, that's the other things you got to look at. These are the current estimates. Nothing looks overly hot here, but you're still going core CPI year over year, 3.3% as I see it. And the core number is nowhere near the 2% that the Fed's looking at. The other thing that I love to look at comes in with the PPI to see where that's running. I can see that running fairly good here. So that takes me to wondering, what is this market going to do? Well, one of the things I always look at is to see what the traders are betting. Now, what do I mean by that? You can look and see how is the market responding by the CME Fed Watch, and I can look at the charts in the market. So why don't we together take a look at charts? And what I've done here for you is I'm looking at a peak that we made in the March T-bonds, the 30-year bonds, and that happened September 17th. We broke down recently to these lows, and we've had a bounce. These numbers in red are Fibonacci retracements. Now, some people use them, some don't, but markets have action and reactions. That's the way to look at it. Normally, the first spot you go up and fight a battle would be about a 1/3 retracement. Here's a 50%, here's a 2/3. What I like on this chart is the momentum's locking in. I view momentum on the slow stochastic, which is the bottom here, and I do modify this study a bit. Your numbers won't match up with mine unless you're a subscriber, and I give you the formula for it to what we do. When both numbers are going sideways over 80 until the red line closes back under 79, the odds favor the market's going to get well bought and try to continue to rally until that event happens. The next chart that I look at is here is the 10-year. It's the same thing. You had your big rally. You dropped down from that September time frame, and you're coming into the 1/3 retracement. And what you're not, and by the way, this one is also embedded, and what you're not embedded with are the 2-year. Now, this is where the Fed is most powerful. The further out you go in time, the Fed doesn't have the power as to what it does in short-term money. And in this market, we are still looking at a marketplace that is having trouble even getting to a 1/3 retracement. All right, so where does that put us then for the Fed doing anything on the December 18th meeting? Well, the page I'm bringing you to right now is Look at the date. See it right here? December 18th. The market's putting a probability that a rate cut of 25 basis points will happen. Is the market thinks that 85 percentile vote. Yesterday you were at 71%. Now you're at 85.8. Leaving things current and unchanged down to 14%. What about January? Just to take a look and see. Well, traders think that come January, what the Fed's going to do is they're going to cut in December, not cut in January. That is why if you take a look, you can see right here, staying with the market playing around. Will the market be able to do anything? In March, look at how the sway is here. The market can come back down. So you've got to figure that what the market's looking at now is changing. The market seems to be breaking in that you'll get a December, you might get a March, you might get a June. That'll take you to the 3 or 4 cuts. Do we know that that's how many they want? Not completely yet, because we're going to get the dot plot on December 18th. It'll give us a better idea there. Now, how do you keep up with me to stay attuned to all this? It's actually very simple. This is our website, and you can see it's IraEpstein.com. And when you come here, each day I create a new video, and I post them here, and it gives you an idea of the headline of what we're doing. I will change everything through here, but it's through all this that you keep up with me, especially my research, because that's where I'm actually telling clients, buy here, sell there, do this. I write 2 reports a day. I put out a lot of information, and we have them what we call subscriber videos. Not the ones for the general public, which are the 4 that I rotate here all the time, but rather the ones that I put out every morning. As the market opens 6 in the morning, I'm actually doing it for the futures, and ideally near 9 a.m. Central Time for the spider. Why 9 a.m.? Because I want that aftermarket money to get in that first half hour. Plus, there's a number of government reports, and they're normally done by 9. By looking at the market then at 9 o'clock, I've got everything I want in there, and we can come out and we review 40 to 50 charts. You heard me, 40 to 50 charts each and every morning, but we give you an area so that when you scroll through, let's assume you only want to do interest rates. ETFs or the futures, go right there. Metals, you go right there. It's all labeled for you so you can go through it. And we do mix longer term, shorter term. Take a look at the site. Hope you enjoy everything. I'm Ira Epstein. Good trading too.